Introduction to Risk Management introduces the principles and objectives of risk management within the program. Risk management is the process of identifying, measuring, monitoring, and controlling uncertainties that may negatively affect investment portfolios, businesses, or financial institutions. Effective risk management seeks not to eliminate risk entirely, but to ensure that risks taken are consistent with an organization's objectives, financial capacity, and strategic goals. Financial markets are inherently uncertain because asset values are influenced by economic conditions, interest rates, inflation, political events, and investor behavior. Consequently, successful portfolio management requires disciplined risk assessment and continuous monitoring to protect capital and support long-term financial stability. The topic explains that risk exists in many forms across financial markets and investment activities. Market risk arises from changes in security prices, interest rates, exchange rates, or commodity prices that affect portfolio value. Credit risk refers to the possibility that borrowers or counterparties fail to meet financial obligations. Liquidity risk occurs when assets cannot be sold quickly without substantial price concessions. Operational risk results from failures in systems, processes, technology, or human actions. Legal and regulatory risks stem from changes in laws or compliance requirements. Each risk category affects financial institutions and investment portfolios differently, requiring specialized measurement tools, internal controls, and management strategies to maintain acceptable risk exposure levels. A key concept within the topic is the relationship between risk and return. Investors generally require higher expected returns as compensation for accepting greater uncertainty. However, excessive or poorly managed risk can threaten financial stability and lead to substantial losses. Risk management therefore aims to optimize risk-adjusted returns rather than simply maximize profits. Portfolio managers evaluate how much risk is appropriate relative to expected reward and investor objectives. Diversification, asset allocation, hedging, and position limits are commonly used to manage portfolio risk exposure. Effective risk management also improves decision-making by helping investors understand potential downside outcomes, volatility patterns, and the financial consequences of adverse market conditions. The topic also emphasizes the importance of diversification as a fundamental risk management technique. Diversification reduces unsystematic risk by combining assets whose returns are imperfectly correlated. Losses in one investment may therefore be offset partially by gains in another. Diversification can occur across asset classes, industries, geographic regions, currencies, or investment strategies. Although diversification cannot eliminate systematic market risk caused by broad economic factors, it remains one of the most effective methods for reducing portfolio volatility and improving portfolio efficiency. Investors who fail to diversify adequately may expose themselves to unnecessary company-specific or sector-specific risks that could otherwise be mitigated through disciplined portfolio construction and asset allocation practices. Risk measurement tools are essential components of the risk management process. Common measures include variance, standard deviation, beta, value at risk, VAR, stress testing, and scenario analysis. Standard deviation measures overall portfolio volatility, while beta estimates sensitivity to market movements. Value at risk estimates the potential loss a portfolio may experience over a specified time horizon under normal market conditions. Stress testing examines how portfolios perform during extreme economic or financial scenarios such as recessions, market crashes, or liquidity crises. These tools help portfolio managers quantify potential losses, assess vulnerabilities, and determine whether current risk exposures remain consistent with investment objectives and institutional risk tolerances. The topic further discusses the role of governance and internal controls in effective risk management. Financial institutions establish risk management frameworks that define responsibilities, reporting structures, and limits on acceptable risk exposure. Independent risk management functions monitor compliance with policies and identify emerging threats. Strong governance promotes accountability and reduces the likelihood of excessive risk-taking driven by short-term incentives or poor oversight. Historical financial crises have demonstrated that weak governance, inadequate controls, and excessive leverage can produce severe financial instability. Consequently, regulators and institutions increasingly emphasize transparency, stress testing, capital adequacy, and comprehensive risk oversight as essential components of modern financial management and investment operations. Behavioral factors also influence risk management effectiveness. Investors and managers may underestimate risks during favorable market conditions due to overconfidence or excessive optimism. Emotional reactions during market stress can lead to panic selling, poor decision-making, or abandonment of long-term investment strategies. Behavioral biases therefore create additional challenges for managing financial risk effectively. Investment professionals must maintain disciplined analytical processes, objective risk assessments, and structured decision-making frameworks to reduce the influence of emotional and psychological pressures. Successful risk management requires not only quantitative analysis but also strong organizational culture, ethical standards, and awareness of human behavioral tendencies that may distort rational financial judgment. Overall, topic demonstrates that risk management is a critical function within investment management, financial institutions, and global capital markets. Effective risk management involves identifying various sources of uncertainty, measuring their potential impact, implementing mitigation strategies, and continuously monitoring evolving market conditions. Diversification, quantitative risk measurement, governance frameworks, and disciplined oversight all contribute to protecting portfolios and institutions from excessive losses. At the same time, risk cannot be eliminated entirely because uncertainty is an inherent feature of investing and economic activity.